Welcome to Simple Investing Secrets. In this video, we're going to talk about the 20 best dividend stocks for retirement portfolios. So before we start, please like this video and subscribe to our channel for weekly updates. Let's get started. Stocks are great holdings for a retirement portfolio, and excellent choices for anyone looking to fund all or part of their retirement with dividend income. A well-balanced retirement portfolio can include dividend equities, and an increasing number of investors are doing just that. We've selected dividend stocks that can provide quarterly income that reduces losses and amplifies gains, reducing the impact of market downturns or igniting rallies. It makes a ton of sense to build a retirement portfolio that includes a sizable portion of companies with alluring dividends, according to David Giroux, a portfolio manager at T. Rowe Price. Your dividend should increase if the typical market business can increase its earnings by 7% to 8% annually. With that said, let's take a look at 20 of the best dividend stocks for retirement portfolios. Number 20. Hormel Foods, ticker, HRL. Hormel has come a long way since its founding in 1891. The Minnesota-based company boasts a portfolio of more than 40 brands that are ranked first or second in their categories and sold in over 80 countries around the world. As Hormel strengthens its product portfolio through acquisitions and new product launches in growing categories like plant-based foods, adjusted diluted EPS should grow as well. That's why analysts are anticipating 5.5% annual adjusted diluted EPS growth through the next 5 years. With the potential for a recession, consumer staple stocks are a sure bet amid an economic downturn because consumers can't live without food. And few consumer staples are as proven as Hormel Foods. Stacked against the S&P 500 index's 1.7% dividend yield, Hormel's 2.4% yield is enough to satisfy the appetite of most income investors. And the Dividend King's dividend growth streak of 56 consecutive years looks like it is far from over. Number 19. Microsoft, ticker, MSFT. The start of a new year is an excellent time to add to your portfolio, with plenty of opportunities for growth ahead. A sell-off in 2022 has put numerous stocks on sale this January, including growth stocks that will likely provide significant gains over the long term. For example, Microsoft and Alphabet have watched their stocks tumble over the last year. However, these companies have continued to report revenue growth despite a poor economic climate. As investing star Warren Buffett has said, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Holding strong growth stocks for the long term can safeguard your portfolio from macroeconomic declines, as has been the case in the last year. Microsoft has retained 151% growth in its shares since 2018, even with a recent sell-off. Microsoft stock is easy to recommend with its triple-digit stock growth in the last 5 years and its strong position in multiple lucrative industries. The company's homegrown brands, such as Windows, Office, Xbox, and Azure, have become powerful forces within their respective industries and provide a promising future for the tech titan. In fact, its average 12-month price target is 33% higher than its January 5 price of $222.31, with analysts expecting it to hit $295.17. Number 18. PepsiCo, ticker, PEP. Pepsi goes head-to-head with Coca-Cola in pursuit of soft drink sales. But this company has so much more product diversity because of its snack food business. This includes products like Lay's chips, Doritos and Fritos. Pepsi has been using its excess cash flow to pay dividends every quarter since 1965, and increasing the dividend rate per share annually since 1973. While sales volume across the business has been roughly flat over the past year due to high inflation, the company is generating strong growth through price increases. Third quarter revenue advanced 16% year over year, excluding the impact of foreign currency, acquisitions, and divestments. PepsiCo increased its dividend by 7% in 2022. The company generated $6.4 billion in free cash flow on $83 billion of revenue over the last 4 quarters. And it paid out 95% of its free cash flow in dividends, bringing the current dividend yield to 2.49%. Despite higher inflation and other macroeconomic headwinds impacting consumer spending, PepsiCo continued to see double-digit growth at restaurants, convenience stores, and gas stations. It's these qualities that make PepsiCo a solid long-term investment for retirement portfolios. Number 17. United Parcel Service, ticker, UPS. UPS has created a strong economic moat with its vast investment in trucks, airplanes, distribution centers, and technology, making it tough for competitors to enter and compete with them in this field. Most importantly, economic moats protect profits. And UPS management is more than willing to share those profits with stockholders in the form of dividends. Furthermore, with the trend toward more shopping online, which typically means home delivery, UPS has benefited from higher demand for its services. Finally, for nearly 50 years, the company has either maintained or increased its dividend rate per share, rewarding investors with a rising stream of dividend income. Number 16. Realty Income, ticker O. Realty Income is a real estate investment trust or REIT that is known for paying monthly dividends. The company owns and leases out thousands of commercial properties located mainly in the United States. Some of their high-profile tenants include Walgreens, 7-Eleven, FedEx, Walmart, and Home Depot. Realty Income owns more than 11,000 properties in the US and Europe, most of which are rather recession-resistant and less vulnerable to e-commerce disruption than many other retail businesses. Plus, Realty Income's triple net lease structure helps create a steady, predictable income stream. The proof is in the performance. Since its 1994 NYSE listing, Realty Income has produced 15.1% annualized total returns, handily outperforming the S&P 500. It has paid over 600 consecutive monthly dividends, current annual yield is about 5% and has increased its payout a staggering 116 times, with no dividend cuts along the way. Number 15. AbbVie, ticker ABBV. AbbVie was founded in 2013. Formed when Abbott Laboratories spun off its pharmaceutical products division into a standalone company. Every year since then the company has raised its dividend rate per share, sometimes more than once in the same year, making for rapid dividend growth. AbbVie had a strong year in 2022, with its shares rising 19%, a mirror image of the S&P 500's performance, which fell by a similar percentage. Strong and consistent results have made the healthcare stock a popular investment to hold over the past year. AbbVie grows its pipeline of new drugs through innovation and investment in research and development. Also, making targeted acquisitions to expand its product capabilities. Most notable, in a growth and diversification effort, the company acquired Allergan in 2019. The maker of Botox. Not only is AbbVie cheap and growing, but it also offers an attractive dividend that yields 3.7%, nearly 2 percentage points better than the S&P 500 average of 1.8%. AbbVie is also a dividend king, enjoying a strong reputation for continued dividend growth. And with a payout ratio of less than 75%, the dividend looks to be in solid shape. Number 14. American Electric Power, ticker AEP. AEP considers itself a premier electric utility company, generating and delivering power to customers in the Midwest United States and Texas. There's nothing too exciting about what AEP does, except in those rare cases when the power goes out. AEP provides a good current dividend yield, plus steady dividend growth and dividend safety. For example, the company has paid a cash dividend every year since 1910. And from 2010 forward, AEP has increased its dividend rate every year. Number 13. 3M, ticker MMM. A company with a wide range of products that affect our daily lives is 3M. For instance, they produce goods for the automotive, electronics, energy, and healthcare sectors, among other industries. Furthermore, the company has paid uninterrupted dividends to its shareholders for more than 100 consecutive years, and increased the annual dividend rate every year since 1958. That is an impressive dividend increase streak, earning 3M Dividend King and Dividend Aristocrat status. We like having an industrial company in this mix of stocks. These stocks are sensitive to the global economy. But 3M seems to just keep moving forward no matter the economic climate. Number 12. Clorox, ticker CLX. Clorox is the maker of the iconic bleach brand that goes by the same name. But what you may not know is this company has tremendous strength across a variety of household goods categories, holding the number 1 or 2 position in many of the areas it competes. More importantly, for dividend investors is the company's awesome dividend history and track record. The consumer staples giant is currently offering investors a generous yield of 3.2% as of January 2023. That's toward the high end of the company's historical dividend yield range. The company has increased its dividend annually for over 45 consecutive years, making it a dividend aristocrat. Number 11. Chevron, ticker CVX. Chevron was able to steadily raise its distribution over that time, in contrast to rival ExxonMobil, whose dividend looked like it would be reduced in recent years due to a sluggish global energy market. In contrast, ExxonMobil announced its first dividend raise in 2.5 years when it did so in October. At the company's Investor Day earlier this month, CEO Michael Wirth stated that we anticipate increasing cash flow to support rising dividends. Without a question, the increase in oil prices has been a positive factor for Chevron's capital gains, including its dividend. Number 10. Coca-Cola, ticker, KO. Coca-Cola is one of the world's leading non-alcoholic beverage companies. This company's unprecedented brand strength has been generating profits for dividend investors decade after decade. The corporation has only modestly increased its dividend in recent years, at a low single-digit rate. Coca-Cola has been the model of dividend stability, raising its distribution for 60 years running. Additionally, the corporation has been authorized to buy back $10 billion worth of shares. Finally, Coca-Cola started paying dividends in 1920 and has paid a cash dividend every quarter since then. The company has increased the dividend rate per share annually since 1963. Number 9. Colgate-Palmolive, ticker, CL. Colgate-Palmolive is a global consumer products giant that first paid a dividend way back in 1895, but began increasing the payout annually in 1963. Best known for its toothpaste and dishwashing liquid, Colgate also owns a portfolio of popular brands such as Speed Stick Deodorant, Murphy Oil, Irish Spring Soap, and Ajax Household Cleaner. The consumer goods firm is ready to increase its yearly dividend for the 60th consecutive year. With the stock down sharply in 2022, Colgate-Palmolive is trading at a reasonable 22 times next year's earnings. For those with a long-term investment horizon who don't need the money for bills or an emergency, a spin-off of the Hill's pet nutrition business could be the catalyst that moves the needle on this dividend king. Although the level of inflation isn't anticipated to last for very long, Colgate-Palmolive's prospects for continuing to pay out and increase its dividend each year seem like a strong long-term investment. Number 8. Johnson & Johnson, ticker, J&J. Johnson & Johnson is a holding company, which engages in the research and development, manufacture and sale of products in the healthcare field. It operates through the following segments: consumer health, pharmaceutical, and medical devices. Few businesses can rival Johnson & Johnson's length and stability of dividend, making it a solid investment for dividend retirement. In April 2020, as many corporations were suspending or reducing their dividends due to the pandemic, the healthcare conglomerate implemented a quarterly dividend rise of 6% to $1.01 per share. The quarterly distribution was increased once more by the firm in April 2021, to $1.06 per share, for the 59th year running. Number 7. JP Morgan Chase, ticker, JPM. Now that it has moved past pandemic-related restrictions on dividend growth imposed by the Federal Reserve, the country's largest bank by assets has its payout on a good trajectory. In the fall, the company boosted its quarterly dividend to $1 a share, up 11%. JP Morgan Chase shares are still priced modestly at 11.6 times last year's likely earnings and 10.5 times this year's projected per share profits. The dividend yield of just under 3% is also above the market's average for a blue chip of this size. That's a dividend, by the way, that was never in any real jeopardy. Last year's projected bottom line of $11.68 is still well above the stock's present annualized dividend payout of $4 per share. This year's expected profit of $12.86 per share makes for an even larger cushion. Number 6. NextEra Energy, ticker, NEE. NextEra Energy Incorporated is an American energy company with revenues of over $18 billion in 2020, and about 14,900 employees throughout the US and Canada. It is the largest electric utility holding company by market capitalization. NextEra Energy, however, offers two plays in one. Utilities are popular among equity income investors. NextEra is also a major player in alternative energy, notably wind and solar. These alternatives diversify its revenue mix and help solidify the dividend. In February, the company's board declared a quarterly dividend of 42.5 cents a share, an increase of about 10%. It's the latest in a series of double-digit dividend increases that make life easier for retirees. Number 5. Procter & Gamble, ticker, PG. Consumer staples giant Procter & Gamble has increased its dividend for 65 straight years, making it a dividend king. That steady upward climb appears likely to continue. The company has an excellent track record of increasing its sales by acquiring and developing name-brand household products to meet consumers' needs. In fiscal Q1, it generated $3.4 billion in adjusted free cash flow, well above the $2.3 billion cost of the payout during that period. In January, the company said it expects earnings this fiscal year, which ends in June, to increase by 6% to 9%, likely paving the way for a bigger dividend. Moreover, it has built this dividend on what looks like a narrow competitive moat. Fortunately, it widened that moat through brand marketing. Offerings such as Tide detergent, Pampers diapers, and Oral-B toothpaste are well established, and this has engendered a high degree of brand loyalty. That devotion should support both the dividend and the stock over time. Number 4. Johnson & Johnson, ticker, J&J. Johnson & Johnson is a diversified healthcare company that helps people live longer, healthier lives with their robust assortment of products. Johnson & Johnson is a recession-resistant business that provides essential goods and services. With annual dividend increases dating back to 1963, J&J is yet another dividend king on our list of the best income stocks for retirees. Finally, this is a perfect stock for setting up an automatic dividend reinvestment plan. Number 3. Target, ticker, TGT. It hasn't been an easy year for Target, with its stock down about 37% in 2022, but the retail giant has been paying out and increasing its dividend for 51 straight years, and I doubt it's going to want to end this streak anytime soon. As a retail giant, Target's business is heavily impacted by the health of the consumer, which has started to wane recently. In its third quarter earnings report, Target's CEO Brian Cornell said that at the end of the quarter, sales and profit trends softened meaningfully, with guest shopping behavior increasingly impacted by inflation, rising interest rates, and economic uncertainty. He added that Target plans to recommend later this year that its board approve a per share dividend increase in the 20% to 30% range as we continue to move toward a 40% payout ratio over time. During the previous fiscal year, Target declared dividends of $3.38 a share on earnings of $13.56. That's a payout ratio of around 24%, leaving room for dividend hikes. Number 2. Union Pacific, ticker, UNP. A favorite stock of the exceptional investor Warren Buffett. This freight railroad boosted its quarterly disbursement late last year to $1.18 a share, an increase of about 10%. It declared a similar increase in the second quarter of 2022. At 1.8%, the stock's yield isn't all that exciting. Hightower advisor Stephanie Link sees this as more of a dividend growth play than a pure play on yield, an essential element of a retirement portfolio. The company's dividend payout is smaller than its share repurchases, $2.8 billion versus $7 billion in 2022. Number 1. Verizon Communications, ticker, VZ. Verizon is supplier of both wireless and wireline telecom services across the United States. The company owns and operates one of the largest networks in the US and is pushing its business forward with more superfast fiber optics capacity. Also, 5G technology to power the Internet of Things. This stock offers a nice yield of around 5%, but the trade-off is that the dividend has been growing slowly. By investing in Verizon, you get one of the higher dividend yields, while not compromising dividend safety. Jenny Harrington of Gilman Hill Asset Management says heavy investments in 5G could help earnings growth, which she expects to be modest in the near term. Although the company increases its dividend every year, those increases are typically small, roughly 2%. The telecommunications giant Verizon has been a great income stock over the years. The company delivered its 14th consecutive annual dividend increase in 2021. Verizon should be able to continue increasing its dividend as it invests to transition its mobile network to 5G, thereby bringing faster data speeds to its customers. This concludes our list of the 20 best dividend stocks for retirement portfolios. As always, it is essential to do your due diligence before committing your hard-earned cash to buying stocks or investing in the market. Which of these 12 long-term stocks would you like to add to your retirement investment portfolio? Let us know in the comments below. Remember to like this video and subscribe to our channel for weekly updates on the best stocks to buy and cutting-edge investment strategies for building wealth. Thanks for watching, and best of luck with your investments.